When people talk about the markets, they usually mean the stock market or the bond market. But there's another corner of the financial world that runs constantly behind the scenes, keeping money moving smoothly from day to day. It's called the money market. The money market isn't a single exchange or location, it's a network. A global web of banks, corporations, and governments lending and borrowing for very short periods, typically less than a year. Money market instruments are where large institutions park temporary cash or borrow to meet immediate needs. For investors, these instruments offer safety, liquidity, and modest returns, the financial world's equivalent of a good night's rest. They come in many forms, but all share two things. They mature in a year or less, and they carry minimal credit risk. Let's walk through the key players. The best known is the Treasury bill, issued directly by the U.S. government. T-bills mature in 4, 13, 26, or 52 weeks. They're sold at a discount and mature at par. The difference between what you pay and what you receive is your interest. Because they're backed by the full faith and credit of the United States, they're considered virtually risk-free. Next are commercial paper, short-term unsecured notes issued by corporations, often blue-chip companies with high credit ratings. They're used to finance accounts receivable, inventories, and other short-term liabilities. Maturities typically range from 30 to 270 days. Commercial paper is issued at a discount, like a Treasury bill, and it's exempt from SEC registration if its maturity is less than 9 months, and it's used for current corporate needs. Banks also participate through bankers' acceptances, short-term instruments that facilitate international trade. Here's how they work. An American exporter sells goods to a foreign buyer. The buyer's bank issues a time draft, a promise to pay the exporter at a future date. When that draft is accepted by the bank, it becomes a banker's acceptance. The exporter can hold it to maturity or sell it in the money market at a discount. These are considered safe because the bank's credit stands behind the payment. Another familiar product is the Certificate of Deposit, or CD. When you deposit money in a bank for a fixed term, you receive a CD, an acknowledgement that the bank owes you that money plus interest. Most of the CDs investors hear about are small, retail deposits insured by the FDIC, but the negotiable CD, or jumbo CD, is a different instrument. These are large denomination, typically $100,000 or more, issued by banks and traded between institutions. They're negotiable, meaning they can be sold on the secondary market before maturity, and they're backed only by the bank's credit, not FDIC insurance. A related product is the repurchase agreement, or repo. A repo is essentially a short-term collateralized loan. One party sells securities, usually treasuries, to another with an agreement to repurchase them later at a slightly higher price. The difference between the sale and repurchase price represents interest. Repos are widely used by banks, dealers, and the Federal Reserve to manage short-term liquidity. When the Fed wants to inject money into the system, it buys securities under repo agreements. When it wants to tighten, it sells them. The reverse repo is simply the other side of the same transaction, a dealer's perspective, when it's the buyer first and seller later. Municipalities can also issue short-term obligations for interim financing. These include tax anticipation notes, TANs, revenue anticipation notes, RANs, and bond anticipation notes, BANs, each repaid with the future revenue source it's anticipating. Corporate investors may also use money market mutual funds, which pool investor cash and purchase diversified portfolios of short-term instruments, T-bills, commercial paper, and repos. These funds aim to maintain a $1 net asset value and provide easy access to cash with limited risk. While money market instruments are considered safe, they're not entirely risk-free. Inflation risk always exists, the possibility that returns fail to keep pace with rising prices. And though credit risk is minimal, it can't be ignored. The 2008 financial crisis made that clear when some commercial paper issuers defaulted, shaking confidence even in the most conservative corners of the market. For the Series 7, here are the distinctions you'll want to remember. Treasury bills are direct U.S. obligations, quoted on a discount yield basis. Commercial paper is short-term, unsecured corporate debt, usually issued at a discount. Bankers' acceptances finance trade, guaranteed by banks, and are time drafts. Negotiable CDs are large, short term deposits tradable on the secondary market. Repurchase agreements are secured loans using securities as collateral. Money market mutual funds offer diversification and liquidity, but are not guaranteed or insured. In all cases, maturities are short, yields are low, and safety is high. When interest rates rise, the yields on new money market instruments adjust quickly. When rates fall, they adjust down just as fast. That makes them useful for investors who need temporary parking for cash, but still want to earn something while waiting for better long term opportunities. If the Series 7 asks about suitability, money market instruments are appropriate for investors who need liquidity, safety, or a short holding period, not for those seeking high returns. They're the instruments that make up the bloodstream of modern finance: steady, constant, quietly circulating capital through the system every single day. In the end, the money market is where cash learns patience. Not too long, not too risky, just long enough to keep the world's financial heartbeat steady between one investment and the next.